Hi, and welcome to Mortgage Solutions. I'm your host, Jim Perkins, and my co-host is Mark Rigney. We are pleased to have as our guest today one of the true legends in mortgage financing, Dave Oliverio. Dave has had a storied career in mortgage banking. In a 15-year period, Dave was the top producing loan officer in the Northern Virginia region. Dave has also been very successful at managing and ownership of mortgage banking companies. Most importantly, Dave achieved all the above with the utmost respect from the realtor community and among his peers. The topic of discussion today is the myth buster. I'm curious to hear from Dave exactly what the term myth busting means. Hi, Dave, and welcome to Mortgage Solutions.
Hello, Jim. Hello, Mark. Thank you for having me here today.
Sure.
As a matter of fact, I've seen the show, great show.
Thank you,
Why the name Mythbuster?
Yes.
Certainly not because it's easy to pronounce. But at any rate, I'm here to dispel the notion that there's currently in today's environment a unforgiving mortgage market, where it's virtually impossible to get home loan financing, especially for the first-time home buyer. Over the past 2 years, there have been plenty of information that's been disseminated out to the general public where the entire tone of the message is to discourage homeownership inquiry rather than to encourage homeownership inquiry.
Right.
So what I say is enough said about what cannot be done. Let's focus today on what can be done and all the opportunities that are out there for that first-time home buyer.
Dave, it sounds like you're implying that there is inaccurate information out there about the home buying options. What are some of these obstacles or barriers that you are referring to that are discouraging prospective buyers?
Good question, Mark. There are plenty of barriers and obstacles out there that have been placed in front of the first-time home buyer. For starters, I would say 20% down as a minimum down payment.
Right.
That severely limits home buying opportunities.
Mm-hmm.
For instance, on a $200,000 sale price, that would be a minimum down payment of $40,000. A $300,000 sale price would be a minimum down payment of $60,000.
That's a lot of money.
That's a lot of money, and it does limit that marketplace. Mm-hmm. Also, a minimum of a 2-year credit history with a limit of 3 to 5 open and active accounts. Mm-hmm. That's another barrier to preventing these first-time home buyers from home ownership.
It's been my experience lately that you can actually go out and build a credit report for a prospective buyer. Possible cell phone bills, utility bills. We can have that information added to the credit report, which actually can build a credit report and make them qualify for a mortgage loan.
Yeah, that's a very good point, Mark.
Mm-hmm.
And yes, that can be done. And later on in discussion, we may go over we may have a few ideas for
Okay,
these
now you
first-time
mentioned
home buyers.
smaller down payments. Now, how can a borrower or individual buy a home today without any savings at all? What are their options out there?
Well, first of all, they're going to need some help from a family member and or a friend.
Gift.
In the form of a gift. Mm-hmm. But it certainly is possible. So basically what we're saying today is that, yes, you can have no savings, and yes, you can qualify for a home loan for that first-time buyer, assuming that they have some support from a family member or friend or even an employer.
Mm-hmm. And now let's not forget about the VA loan too, which can do 100% financing, and the seller can pay all your closing costs.
We certainly haven't forgotten about that.
Mm-hmm.
That's also a great program.
Is the gift the only area that they can come up with the financing? Can they borrow it from other resources that they might have? Or?
In general, it's very difficult to borrow money for that first-time home buyer. Most loan programs, all loan programs that I'm aware of, don't allow the home buyer to borrow money unsecured. And in many cases, for instance, automobiles or maybe even a book collection, they can borrow secured, but I find that very rare.
But they can
do
borrow
that.
against their own assets. If they have a second trust on a property, or if they have a secured loan, share secured loan, they can borrow against those assets?
That's certainly a possibility, but in general, a first-time home buyer, at least what I've seen over the years, they're not going to have a lot of assets, or they would not be a first-time home buyer with no savings.
Some of them don't realize, though, that a TSP, a thrift savings plan, a retirement account, they can borrow against those assets for the purpose of a down
A
payment.
very good point. And there are a number of first-time home buyers that may have some small savings, some small thrift accounts that they can borrow against. Normally, that's a 60% of their total asset value in the thrift account, but that's certainly a possibility.
Now, you mentioned borrowing, getting a gift from a friend. They don't necessarily have to be a blood relative for them to get a gift?
It does not have to be a blood relative, but it must be a friend with a long-standing relationship. And what do we mean by a long-standing relationship? That's fairly subjective, but generally a few years, and we would get a statement from that friend indicating the type of relationship that they have with the first-time home buyer.
So a statement then would be enough to determine that that person has a long-term relationship? Or
What
is
are
there
some
gonna
of the
need some other
underwriting
documentation?
Yeah, in general, a statement will satisfy that requirement. There's not much more that you can do other than a statement. So underwriters have accepted a handwritten statement from the friend, and that normally satisfies it.
Now, with the gift, are you saying that the person's going to have to get a gift of the 20%? If you're talking like a $200,000 house, it's going to be $40,000? Or is there programs that will allow them to put less than the 20% down?
Yes, there certainly are programs that will allow them to put much less than 20% down. As a matter of fact, we have a program. Let's go back to that $200,000 sale price scenario that I had brought up earlier in the conversation. That would be a minimum of a $7,000 investment versus a $40,000 investment. So a $200,000 sale price with a $7,000 down payment,
3.5%.
which is 3.5% of the sale price, can address the situation and allow that first-time home buyer to get into the home of their choice.
That sounds much more reasonable, using somewhere around $7,000 as opposed to 3.5%, as opposed to 20% down. The gift. My question is on the gift. Does it all have to come from one person, or can you get a number of different gifts?
It does not have to come from one person. That is a good question. For instance, that $7,000 can come from 7 different people. $1,000 a pop is certainly manageable. So we're not concerned about it coming from one person. Quite frankly, what we are concerned about is that it's truly a gift and not a loan. And the gift letter statement will require the intent from the donor and the recipient to state that it is truly a gift.
Well, why is it so important that it has to be a gift? Why can't it be a loan? Why can't you borrow $10,000 from your brother? What issues is underwriting going to have with that?
Right. In general, it's another obligation, another burden for that first-time home buyer to carry, and underwriters do not like to see that.
Increases their debt ratio.
Increases their debt. It's just another burden on the first-time home buyer. So we're trying to eliminate as many burdens as possible on the first-time home buyer.
Now, with that, if a person has a large number of close friends or a large family, then they'll be able to come up with gifts that might be able to get that 3.5%. Are they going to need anything more than that 3.5% in order to purchase the property, or?
Jim, large families certainly can help, especially large supportive families can help. But a good question is the $7,000 the end of the story? And quite frankly, no, it's not the end of the story. Generally, as a ballpark, there's a there's a range of approximately 3% of the sale price for what is called closing cost. So if we have a $200,000 sale price, we're looking at approximately $6,000 more in closing costs. So if you take the 6 plus the 7, that's a $13,000 total investment. But what we as a lender require from the first-time home buyer is the $7,000. How they work it out, meaning can they get the seller to participate? Can they get the agent to participate? Or can they get the lender to participate? So there's a lot of ways of accomplishing that goal of a $7,000 minimum investment on $200,000 sale price.
We'll go into a little bit more detail about that, about getting your lender to take notice, or getting your real estate agent to help out with that.
Sure. Would love to. At a $200,000 sale price with the 3.5% down, that's the $7,000
Right.
investment. So a home is on the market for $200,000. My suggestion to that first-time home buyer and their agent is to go in at full price. In many instances, the first thing, and especially in today's economy, in today's market, that the buyers, prospective buyers, are thinking about is, okay, they're asking $2, I want to offer $190 or $180. In general, that's not going to work. Also, because in the last year and a half, in that price range, there has been quite a bit of demand for those $200,000 to $300,000 sale price. So there's not as much play. But offer full price, then ask the seller to pay the $6,000, and then you've accomplished your mission of $7,000 on $200,000 sale price.
So asking the seller to pay, say, $5,000 is just like coming in at $195,000 for a sales price.
Yeah, effectively.
Good point.
Effectively. Another possibility, another solution may be, let's say that seller is asking $200,000, but we're certain, we're assured, and the buyer's assured that that value may be $206 or $207 or $208. Instead of offering $200,000 in a seller's market in that sale price range, offer $206 and then have the seller pay that $6,000, and then you're back to that net for the seller of $200,000, and everybody should be happy.
Now, is there any protections there for the borrower, say, if they do offer the $206? And say the property doesn't appraise for $206, are they going to have to still buy the house at $206, or?
Good question. We do an appraisal on every loan, and that's where the buyer is protected. So let's say a theoretical or a hypothetical, the appraised value comes in at $200. In the boilerplate of the contract, there is an amendatory clause. It's called a government amendatory clause that gives the borrower an option to bail out if it's 1 penny less than what they've offered. So if it's $206, it comes in at $205.9, the borrower has the option of voiding the contract and getting their earnest money deposit back. So there are some protections for the borrower.
And if it appraises, say, for $220, is he obligated to pay the $220?
It's sale price or appraised value, whichever is less.
So it's kind of the best of both worlds for the borrower. He's protected. He gets it, if it's on the high side, he gets it for the lower value. And if it goes lower, then there's a point of negotiation where he could possibly get it for a lower price than what or at what the property appraised for.
Yeah,